So welcome to another episode of Your Life Simplified. My name is George Fernandez, and today I'm joined by two other frequent hosts, Brian Leitner and Scott Sturgeon. So guys, thanks for joining me on this podcast today.
Thanks for having us.
Happy to be here, George. Broadcasting live from my basement.
Broadcasting live. Yeah, I think we're all broadcasting from pretty interesting places right now, despite the fact that we have been kind of holed up in our homes over the course of the last 3 weeks. You know, we've been having these discussions about the tax law or tax legislation that's occurred over the last 3 years. And as I think about those changes that have been made, I was thinking, maybe it'd be great if we had a podcast that covered this particular topic. We always talk about the importance of being fiduciaries for our clients, being advocates for our clients. And one of the ways in which we do that is staying on top of what's happened over the course of tax legislation or anything else that's going on in our economy. And so I thought, let's have a conversation about what's happened and talk about how we can take advantage of those or benefit from those. And so let's maybe begin with a quick discussion about what's happened over the last 3 years, beginning in 2017. At the end of 2017, we had huge changes, this huge piece of legislation that took place called the Tax Cuts and Jobs Act. And it always happens at the end of the year. I'm not quite sure why that happens. It just seems like we have these big pieces of legislation happen at the end of the year, and then it creates havoc for the next year as we kind of figure out what to do with it. Well, with that particular piece of change, we saw tax bracket changes. We went from 7 to 7. Okay, maybe not too many changes in brackets, but we had a lot of changes in the levels and how you enter those brackets. We saw changes to standard deductions, personal exemptions, itemized deduction rules, state tax rules, 529 plan rules, kiddie tax rules, all of which really impacted a lot of our clients' lives. And so it was pretty impactful. And if you go back to one of our episodes, episode number 2, in fact, Brian, you talked to Rob Trigler on that particular episode about the details of that particular TCJA. But fast forward 2 years, we had something else that happened at the end of 2019. So, gentlemen, pop quiz. What happened at the end of 2019?
You have the Secure Act was passed. And the Secure Act stands for Setting Every Community Up for Retirement Enhancement Act. And there are a lot of changes in a lot of these bills. And I think the purpose of this conversation is to hit some of the larger changes. And so one of them was the stretch IRA. And that is effectively a strategy where you can take distributions out for those that inherit an IRA over an extended period of time. And that's been changed. We're going to get into the details of that. A few of the other changes were that required minimum distributions on retirement accounts moved from, say, 70 and a half to age 72. Then they increased the ability to contribute to your IRAs even after the age of 70 and a half. And that didn't exist for all types of retirement accounts before this was passed. So again, it's a positive thing. Part-time workers got access to the ability to contribute to these types of retirement plans where they didn't maybe have access in the past. And then just like you said, the Tax Cut and Jobs Act in 2017, they made changes to the 529s and kiddie tax. And guess what? They changed those rules in the Secure Act. So good handful of changes. And now we have some more changes, right?
Yeah. I mean, we saw the flip-flop, right? We see flip-flops and undoing changes and that kind of thing. But, but now, here we are, as we just saw, kind of alluded to the front end of our conversation, we're sitting in remote locations, having discussions, like this amid the COVID-19 sequestration from the world, so to speak. But with that, we also saw a pretty significant piece of legislation that came about here. What was it, Scott, about 4 weeks ago? I'm losing track now.
Give or take, as of recording, the days tend to blend together. So, the CARES Act, as the acronym is referred to, the Coronavirus Aid, Relief, and Economic Security Act. Really, I think the biggest tenets of it were, as probably everyone's aware of, tax filing deadlines were suspended to July 15th, 2020. And also required minimum distributions from basically any IRA were suspended as well. So, the 72 now, an older crowd, certainly happy to hear that. And, there's kind of a myriad of other retirement account withdrawal rules that were kind of changed or modified slightly just for 2020. And really, George, you alluded to it, but a lot of that's just in light of, in really this unprecedented pandemic, or at least in our lifetimes, I think. And so, in response to that, Congress and I think the government in general just kind of saw perhaps a need for individuals to have greater access to liquidity within their retirement accounts. And so we saw some modifications there as well.
Yeah, and kind of beginning with that first thing that you mentioned, the tax filing deadline, that brought with it some pretty interesting changes. We've never seen that before. I mean, we've seen a couple of days here and there, but not like the July 15. That was pretty significant. But what I thought was real interesting, Brian, we were talking about this, I think it was about a week ago, and as we were kind of looking at the 7/15 deadline, we discovered something really interesting that at the state level, right? I mean, it was, it doesn't apply the same to every single state.
Yeah, that's right. I mean, so we talk about the deadline being extended, but that, to be clear, that's for federal filing deadlines for taxes, and that's not at the state level. And every state, just as a disclosure, if you will, I mean, states are operating independently, and so some of them are following what the federal guidelines are and their extension, but other states are handling it in a very different way. So I think that's really important. But one of the other key aspects of moving the tax filing deadline back is that actually giving us more time to contribute to our IRAs and our healthcare savings accounts and other types of tax deferred accounts that we've extended. And so I think that's terrific. I think that presents onto itself just additional opportunity to make sure that if we're able to leverage these accounts to the fullest extent possible and sock that money away where appropriate.
Yeah, that's a really great point. I mean, being able to extend that, if you have the ability to set dollars aside, between now and, the time that you do end up filing, that's really a great opportunity that you can take advantage of that maybe you wouldn't have thought of before, but maybe now you have a little bit extra time for that procrastination, so to speak. We talked a little bit earlier about flip-flops or undoing unintended consequences of tax changes. But there were also changes to, we think about all the changes that occurred in the last few years, also changes for kids. And what happened to 529 plans and student loans.
Yeah, I mean, I think the biggest thing, I'll just jump in. When we think about 529 plans, those, unfamiliar, basically it's a tax deferred educational savings / investment account. Expansion on the usage of those, I think, is kind of the word of the day. So, as a result of all of this legislation, basically you can use 529 plans to cover tuition expenses for even private high schools. And even now, more recently, for up to $10,000 of student loan payments for those carrying student loan debt. And really, it's probably a reflection of, I think just the government noticing and realizing there's kind of an educational cost crisis, maybe in the U.S. With people paying for education for college and what have you. So some huge changes there for sure.
So I would just jump in, and from a kiddie tax perspective, there's been a lot of changes over the years, and they've gone back and forth. But it's the idea that you could invest in your child's name and maybe receive a lower income tax bracket, and in terms of paying that, and they've closed that gap yet again, if you will. And so the way it works today is that if you have unearned income, so think about your portfolio income or something of that nature, and it exceeds $2,200, instead of being taxed at your kid's rate, it will be taxed. Anything over that will be taxed at the parent's marginal tax rate. And so that's something that they continue to go back and forth on over the years and play with that as folks are trying to pay less in taxes.
Yeah, exactly. And so, some other changes that we saw were to the standard deduction, personal exemptions. We won't go into a lot of detail on that today, but what it did present was some opportunities for us as well. So when we think of the changes made to the standard deduction, it gave us unique opportunities to charitable contributions.
Right. So, George, you kind of mentioned it, but I think what we saw as a result of kind of all this shuffling really with legislation was the number of people who are taking the standard deduction increased significantly. Probably roughly 70% of the United States took the standard deduction, as of 3 or 4 years ago. Up in the present day, it's probably 90%. So what are ways to kind of think about that, or for those taking the standard deduction to maybe take advantage of that? We have a strategy we kind of employ for some of our clients called bunching of charitable contributions to donor advised funds. It's kind of complicated, so I won't dive into all the minutia, but it basically allows for kind of a 1 year, you're itemizing 1 year, you're taking the standard deduction and going back and forth to reap some tax benefits there. And then really actually more recently, this was kind of an interesting one that, and I don't you just reference the CARES Act specifically, but if you take the standard deduction this year, 2020 specifically, you can donate $300 cash to charity. And on top of your standard deduction, you can deduct that amount as well. So kind of an interesting wrinkle, I guess, probably from a policy perspective. It's to just encourage, quite simply, charitable donations in a really challenging time.
Yeah, exactly. As we had these discussions, one of the things that also came about from all the changes we had were sweeping changes to the retirement savings space. In fact, the Secure Act had probably the largest impact to retirement savings plans and savers, if you will, than 30 or 40 years. I don't think we've had these significant number of changes. And so we kind of break down the various areas where these changes took place. They changed the way in which we contribute, the way in which we take dollars out, and the way in which we pass on these dollars to our beneficiaries ultimately. And so kind of beginning with the changes to retirement plan contributions, probably one of the most significant pieces of that change was being able to continue to make contributions even after age 70 and a half, where you used to not be able to do that. So even if you worked into retirement, you couldn't contribute to an IRA anymore, but now you can. You can continue to keep, contributing even to a Roth IRA. So that's pretty big. That brings about some pretty unique opportunities as being able to do that as well.
Yeah, George, great point. I mean, just the ability to contribute after the age of 70 and a half. I think they recognize that folks are continuing to work longer as we're all living longer as a society. Continue to contribute those dollars and stock them aside. I think that's absolutely terrific. Again, as long as you have earned income, then you can contribute to that IRA, or maybe it's a different type of retirement vehicle. So I think that's important because, again, it's going to continue to compound as well. Other aspects of that, I mean, again, if you're working part-time, so think about that individual who maybe says, I'm going to retire from my job or career at a certain age, maybe that's 68, but they're going to continue to work part-time. They can contribute to whatever that retirement plan that they might have, depending upon if that employer decides to opt into that. But again, they have their IRA. And then that also leads to other opportunities to ultimately look into this Roth IRA that I think there's been a lot of press on, and frankly, for a lot of great reasons. And I think there's a lot of confusion that's out there. A lot of folks might say, well, I make too much money to contribute to a Roth. And that's possible, but everybody can have a Roth. If they have an IRA, there's always the ability to convert that traditional IRA to a Roth IRA, or maybe even contribute to a non-deductible IRA and then ultimately convert that to a Roth IRA. And sometimes that's referred to as a backdoor IRA. And again, all of this is very specific to your own personal situation. It might be a great idea and it may not be a great idea. I think that we want to think about is, what does it look like in the context of your overall, not only your overall wealth plan, but in addition to that, just what it looks like from a tax perspective, and making sure that over the long haul, the strategies that I'm implementing today will make sense for not only myself, but if I'm interested in leaving a legacy or passing assets on, how do I do it in the most tax efficient way, as opposed to relying on, traditional rules of thumb and things of that nature.
So that's a great point, Brian. Can you dig just a little bit deeper into kind of the Roth conversion and how that actually works, and how doing it, impacts their tax savings? Maybe a little bit more detail on that.
I would tell you that there's a couple different aspects of the Roth conversion. So if you have an IRA, and we're again assuming that this is your traditional IRA that you've been socking money away for years, and let's just say, for argument's sake, you have $1 million inside of this IRA. When you convert that, you're going to end up with a tax liability, because this is going to be ordinary income to you. And so that, frankly, that scares a lot of people off, and they say, wow, I don't want to walk away with, paying $300,000 in taxes, or whatever that looks like in this example. Well, a couple of things to think about. We're always talking about, how you mitigate taxes on an ongoing basis, playing with the tax brackets and making sure you fill up lower income tax brackets before pay your highest marginal tax rate. And so you don't necessarily have to convert all this income in 1 year. You can stretch that out. You can pay that out over a period of years, making sure you're filling up those tax buckets, and having a conversation with your wealth advisor and tax advisor. How much potentially should you convert and still pay? Still find yourself in the tax bracket that you're comfortable with, as opposed to paying this all in taxes, because that also is going to impact your Medicare situation, the premiums you pay from that perspective, potentially Social Security and other things. And so you want to be really careful about what this looks like. And so the most important thing, in my opinion, is to simply run a projection. What does it look like if we convert in 1 year? What does it look like if we run it over several years? Make sure that we're not paying any additional taxes that we don't necessarily need to. But the benefit, of course, with the Roth IRA is that ultimately there won't be any required minimum distributions once this conversion takes place. And if these assets are to be passed down, there isn't any required minimum distributions, right, outside of something we're going to talk about in just a little bit regarding the Secure Act. But this is a tax-free entity, again, whether it's for their retirement or the ability to pass this down. Once you pay tax on this, you won't pay taxes again on it, again, from an income tax perspective.
Yeah, those are huge benefits. And we look at the TCJA, in 2017, it gave us all new tax brackets, if you will, which really gives us a great opportunity to take advantage of the way that those work.
The other thing to think about is, I think if I were to ask people 6 months ago, where taxes are headed, everyone would say up. They did. Well, today, based upon what's taking place with all the funding that we're doing at this point in time, I mean, if taxes were going up back then, I would imagine there's an even higher probability. So if you think taxes are going to be higher in the future, potentially taxes are on sale right now. So even converting them, whether it's over a period of time or at least giving that some consideration, if taxes are on sale, you might want to consider taking advantage of it. At some point, I mean, the government's going to get their hands on this. And that's the whole idea with some of the acts that we're talking about. The Secure Act in general is supposed to raise a massive amount of money, about $15 billion over the next several years. So things to think about from that perspective. And again, the conversion is just one opportunity potentially to do that.
Yeah. Great points. It's the kind of like that old saying, the devil you know versus the devil you don't know. We know where the tax devil is today. We don't know where they're going to be in the future. Interestingly, I think a lot of people find themselves typically in higher tax brackets as they get older anyway, not even, that where it used to be, hey, you're going to be a lower tax bracket, so that's why it's tax deferred. A lot of people are not necessarily finding that to be the case.
Thanks again for downloading this episode of Your Life Simplified, which is produced by Mariner Wealth Advisors. And at Mariner Wealth Advisors, we're here to serve as your advocate. We help people chart a course to reach their personal and financial goals so that they can have greater peace of mind that may lead to a more fulfilling life. We do this by always putting our clients first. Because as fiduciaries, we're required to provide guidance that's in the best interest of clients, not in the best interest of a company or shareholders or anyone else. So as you listen to this podcast and have questions about maybe your own financial situation, or would simply like a second opinion, or even you have an idea for a future podcast, please go ahead and email us at podcast@marinerwealthadvisors.com. If you found the information on this podcast valuable, please go ahead and share it with a friend or family member that you think might benefit from this information. And please don't forget to subscribe to this podcast so you don't miss an episode. Thanks for listening, and now back to the episode.
You were talking a little bit earlier about the required minimum distribution. So these dollars do have to come out at some point. And so there were some pretty important things that occurred with the CARES Act that provided some flexibility, and with the Secure Act as well. So we had two things that happened with this, with the Secure Act. We had an increase our required minimum distribution to age 72. So now you begin at age 72. But with the CARES Act, we saw a delay for 2020. And the reason we saw that is at the end of course, the end of 2019, we saw our asset values being at one point, and now where they are today is not quite as high. And so basically what they're saying is they want to burden people with having to pay those taxes at this point based upon those larger values. And so they delayed the RMD for 2020 and suspended that. So that's important. That also gives us some opportunity maybe to plan around that too. So if we have in our first RMD that's going to be coming up, maybe we can also plan around that too. But there was also something else that happened with the CARES Act as it relates to specifically to loans and withdrawals. So one of the things that typically you don't have the ability to withdraw dollars from your IRA until 59 and a half or over, unless you want to pay taxes and penalties, before that, or penalties specifically. But with COVID-19 and with the CARES Act, we now have the ability to do a couple of different things as it relates to loans and withdrawals.
Yeah, I mean, probably the biggest thing, George, I think, is when you look across the landscape of, the average worker's ability to withdraw funds from their retirement accounts, I think, from our perspective, it's generally a big no-no. But, sometimes there's just not other options. And so, in reference to that, a lot of people are going through undoubtedly some really hard times, whether it's, personally or socially or financially or what have you. What we saw recently was we already had the ability to take loans from 401ks, workplace retirement plans. There were some rules around that that got expanded to increase the ability to do so. But one of the really interesting things we saw from specifically the CARES Act was you can now withdraw funds from your IRA, which you could not do previously without paying a penalty, regardless of your age. And then you have the ability to pay that money back into your IRA over a period of 3 years. So you can even paying back the taxes too, which is huge. if you're kind of in a bind for cash flow in the next several months, maybe not the greatest option for the average individual, but certainly something to consider, something to think through as kind of a last option.
Yeah, Scott, I think great points, and especially, the last comment. Look, I know folks are squeezed right now, and there's a lot that people are dealing with, and it's great that this option's available, but it probably should be your last option. I mean, these are dollars that you're really trying to sock away for the long term. And, you think about what your future self, what position that you'll be in then. But again, I know folks are squeezed, and so they've made this available, which is terrific. It is something to know about and think about and potentially consider based on your situation.
Yeah, I'll kind of going back to the podcast that Brian, you and Scott did here just a couple of weeks ago on coping with the crisis. And one of the important things that we should always ensure that we have in place is a emergency cash fund. And I think you talked a little bit about that on that podcast. So getting back to the basics is kind of where we are today. And so that we can, if it's there, if we need it, but that's how we can kind of prevent that from coming to play later. So when we think of, the retirement accounts, I'm also thinking of what happens if we don't spend it all. And where do these dollars go? You've heard me say it before. I'll probably say it here in just a couple of minutes, and that it's the right assets to the right people at the right time in the right way. It's kind of the way that I look at estate planning. And so when I think of the IRAs, what happens to the IRAs? Brian, you alluded to this a little bit earlier, that we used to have what was called a stretch IRA. Well, it wasn't really technically an existing account, of course, but it was a way to pass assets along to our beneficiaries, especially non-spouse beneficiaries, over their lifetime. And that's changed. And with the Secure Act, there were some significant changes to that.
Yeah, so there's people that are out there that will say, is the stretch IRA dead? And I like to say that it's certainly wounded. It's not completely dead. And what I mean by that is there are some exceptions. But let's just maybe briefly discuss what the stretch was for just a second. And so, if you had both spouses and you had junior, for argument's sake, and what ended up happening is one spouse, let's say they had an IRA and their primary beneficiary was, say, their significant other. So that $1 million perhaps would go to the surviving spouse. And then ultimately something would happen with the surviving spouse. And when they pass, it goes to junior, for argument's sake. But junior could take it out over his or her life expectancy. And so maybe that $1 million was going to be taken out over, if junior's 40, 50 years old, maybe over 30, 40, 50 years. They're receiving this income, they're paying ordinary income tax on it, but it's stretched out for so long. Well, today, the changes is that has to be paid out to junior over a 10-year period of time. And if you think about it, certainly if junior is working and successful, they're already potentially in a high income tax bracket. And that $1 million in this example, that's $100,000 a year, potentially, that's coming out. And so they don't have the ability to let that, compound on this tax deferred basis the way they used to over the 30 or 40 years. And so that's one way that the government's going to raise significant tax revenue from that perspective. I say it's wounded and not dead because there are exceptions. So again, similar to the surviving spouse, there's an exception there. So that person, the 10-year rule doesn't apply, just like it did in the previous years with the true stretchability. It doesn't apply to minors. So that 10-year clock doesn't start until that minor becomes age of majority. You could have a beneficiary that doesn't have a life expectancy differential of more than 10 years. So in my example, maybe that individual wants to name their brother or sister as opposed to junior in that example, because they'd avoid the 10-year rule payout. And I think it's important to think about this. There's one thing to save taxes. It's certainly another to what is the ultimate goal that you want to accomplish, and not necessarily letting the tax tail wag the dog. But that's what that looks like. So again, the payouts and the ordinary income is going to come a whole lot faster. And so there are a handful of things to think about, whether it is changing the beneficiary on these accounts, or potentially, a few other things to think about might be you could split that IRA. In my example, I said it was $1 million IRA. You could potentially, instead of it all going to the surviving spouse, maybe half it goes to the surviving spouse and half it goes to junior. A different way to play with, we talked about this on a previous podcast, but a different way to maybe stretch out what those 10-year periods look like. And I know this is somewhat cumbersome, but if you think about it from that perspective, if the first individual dies, it goes to the $500,000 in my example goes to junior, that 10-year clock starts. But the surviving spouse is still alive, so maybe they stretch that out for a period of time, and then ultimately when they pass, maybe it's 10 years later, junior gets those distributions of those monies and starts a 10-year clock. So in that example, that $1 million is actually being stretched out not over 10 years, but over 20 years. So that's an example. Potentially leverage charity as part of your overall plan. Maybe it's not the whole IRA, but if that's something you're close to and want to be philanthropic, retirement accounts are a great way to provide funding to charity. And of course, if you're insurable, again, depending on your overall situation, you may want to take that 10-year payout and potentially buy life insurance proceeds with that, again, depending upon your health and the costs and things of that nature, because inheriting life insurance and passing that on is a much easier asset from a tax perspective to leverage. And potentially you want to keep those monies in a trust as well. So a lot of different planning opportunities here to work around what the government's put in front of us. But again, a lot of it's specific on your overall situation.
Yeah, exactly. You mentioned the charity side of that too. And it is a great opportunity for us to use our IRAs for that. And when we look at the changes to the Secure Act or with the Secure Act, one thing that didn't change was the ability to begin qualified charitable distributions from our IRAs at age 70 and a half. That always coincided with the required minimum distribution years, but today you can still do that at age 70 and a half. You can transfer up to $100,000 a year to a qualified charity right out of your IRA. When you turn 72, it counts as the distribution that you're required to make. But before that, it's still dollars you can still transfer very easily. And so there's some really unique opportunities as it relates to transferring assets to charities. And if you're already contributing to charities to begin with, it's a great tool to use.
Yeah, let me just throw in one extra comment. I mean, for those that have significant wealth and, they're interested in providing to charity, you can obviously give parts of your IRA to charity, but what you could also do is you had someone who was interested in providing to charity, but also creating a stream of income. There are charitable trusts that would enable you to do that. And you're basically contributing your IRA to a charitable trust. And in return, not only are you receiving a tax deduction for that, and ultimately money's going to charity, but you could receive a stream of income payments over your lifetime, which could be a whole lot more than just 10 years. So again, another workaround I wanted to make sure that I communicated. May not be as popular, but something to think about.
Yeah, it's a really great point. Another way to kind of stretch that, you were talking about a little bit earlier, you could have the beneficiaries of that charitable lead trust, if you will, go to the children. And so therefore, you're kind of stretching that out where you weren't able to do that before. So it's a really great point. So kind of along the lines of estate and gift tax, there were some pretty significant changes. Scott, you were telling me that some of our clients will say my net worth is too small to be concerned about estate taxes, but that's not really true, is it?
Well, I think it is and it isn't. In our current environment, the estate tax exclusion is $23 million roughly for a married couple. So, across the United States, all swaths of income and net worths, that's pretty high, admittedly. But at the same time, when we think historically on what estate tax, amounts have typically been, and I'm literally pulling it up to keep myself honest here. In the late 90s, the estate tax exemption was around $600,000 per individual, and that increased into the 2000s. We got maybe $1 million a person up until, the late 2009-10 era, when it increased to $5 million a person. And what's interesting about our most recent legislation is it effectively doubled that amount to currently where it's around $11 million, per individual. In 2026, that sunsets to where it conceivably could go back to roughly $5 million. And $5 million is not a small amount of money by any means, a small net worth. But when you start factoring in all the different assets individuals can accrue over their lifetime, whether it's cars or houses or, just largely investment accounts or businesses and things of that nature, the estate tax issue, if it sunsets again and goes back down to $5 million per individual, could actually be surprisingly affecting more people than we would typically think. And it's just, I think it's something that kind of gets overlooked often, but, given the current environment we're in with historically high exemption amounts, it might make sense for a lot of individuals to take advantage of that. There's a lot of different strategies. Brian, I think you mentioned maybe a couple of those in prior discussions, but there are some certainly things to think about.
When you think about it, if we know that the tax law is going to change, and I like to say that tax law is, sort of written in pencil, right? Because we don't actually know exactly what's going to take place, but there's an election coming up and there's a sunset provision. So if you're interested in potentially transferring some of your wealth today, I think it presents an interesting opportunity for two reasons. Well, actually more than two reasons because of some of the changes I just referenced, but two additional ones is that based upon where we are right now with the markets, so market values are worth less than they were. So it's an interesting opportunity that may change your mindset in terms of, well, I can't give the money away because I just don't know what's going to happen. I don't feel comfortable. And that's absolutely something that folks need to understand. But if they're okay with that and they're still comfortable, with valuations down and with interest rates down quite a bit, there's a handful of wealth transfer vehicles that folks should consider, whether that be different types of trust work that can be implemented today, where you're giving gifts to the trust for the beneficiaries of your loved ones and so forth. That's an interesting idea because, again, the valuations here are going to be based upon the interest rate play. With interest rates being as low as they are, once the assets are transferred into the trust, we think through if the performance of those assets are going to do better than the interest rates that we're dealing with today, you sort of won the game. You've transferred more wealth without paying the gift tax associated with that. So again, interest rates and valuations right now make wealth transfer something that folks should really pay attention to. Maybe lastly, without getting too confusing here, is just intra-family loans. Again, with interest rates so low, there are folks that may want to give gifts to their loved ones for whatever reason. Maybe it's helping someone buy a house or something of that nature. Rather than we see often folks making large gifts and that impacting their overall estate and gift tax situation, maybe consider making a loan with rates being as low as they are and making sure that we follow the rules associated with those intra-family loans. Could be a terrific way in this environment to, again, achieve some of your goals depending upon what you're looking to do. But those are a couple of thoughts as it relates to the state where we are today and potentially where we're going to be.
So to kind of wrap things up here, there really are a lot of moving parts as it relates to the tax legislation over the course of the last 3 years. And we could probably spend another hour talking about some of these topics, but the reality is that I don't think you'd listen for another hour. So maybe, Brian, Scott, can you give us maybe one final thought that we want to kind of be cognizant of as it relates to what we're talking about today?
Sure. I think anytime that there's a market correction, it concerns people, and rightfully so. And we never know exactly when those are going to happen. And of course, the market is up a whole lot more than it is down. But I think it gives us an opportunity to reflect on what our risk tolerance is. In a bull market, everybody's has a risk tolerance of being aggressive. I think now maybe is an interesting opportunity to just sort of reevaluate that, with your wealth advisor and where you are today. And so, if the market has you feeling a certain way, maybe you jot that down over the course of, these days and months ahead. And maybe that'll serve as a reminder in the future, potentially. Or other things to think about is really just taking this opportunity as kind of thinking about this as implementing maybe fire drills throughout, the course of the years. So just thinking through, should this happen? Should that happen? How would I react to that? And really having a game plan now, as opposed to trying to make decisions, in the thick of things when we probably don't use our best judgment. Those are a few things to think about.
Okay. Yeah, all great points, Brian. I honestly, I think mine would echo much of the same. I think that when you think across the landscape of the last couple of months, at least in our world, a lot of the conversation is focused obviously around the market. There's a ton of volatility right now just because no one really knows what's going to happen. I think we've focused on things we can control and kind of conveying that to our advisors and client base. This whole episode is really all about harnessing your taxes for your, for benefit for you, as opposed to the large focus I think we tend to get from whether it's the media or other sources wholly on market returns. There's a large percentage of your portfolio, your overall assets, that you can essentially not outperform, but have additional gain through tax efficiency. And so I think kind of thinking through a lot of these strategies we've kind of talked through and finding whatever is the optimal, setup for your overall net worth is really worth a conversation, even if it's just doing research on your own or talking to some kind of an advisor. I think there's some real benefit there.
Scott, great points. Just to add to this, because I think you're spot on. Making sure that we're incorporating, it's not just investments. I mean, that's a piece of the puzzle. Taxes play a key role inside of the context of one's overall plan. And I think it's often overlooked because maybe the market is just, maybe it's sexier in certain ways. But I think if people really reevaluate what they're doing from a tax perspective, they can see how much money they're ultimately saving. And that's the name of the game, right? It doesn't matter how much money you make, it's what you keep. And so those are great points. And I just wanted to add that.
Yeah. Well, thanks, guys. And my final point or comments would be, I think the importance of what we've listened to today is that there's a lot of moving parts here. And I think it's really important that even though sometimes, we might be smart enough to be able to figure this stuff out on our own, the reality is that, there's a lot of stuff here that we could miss. And some of this could be very costly if we miss the wrong thing or the right thing, right? And so having an advocate that could work with you and alongside you to help guide you through these discussions, I think is really powerful. Scott, you kind of alluded to that as well. So having that tax professional, having that, financial advisor advocate that can work with you is really powerful to help you navigate through some of these things. So I want to thank you all for listening today. I know this podcast might have been a little bit longer than a typical podcast. My hope is that you found it valuable. I shared at the front end of this that I would share a few resources for you that would help you with some of the discussions we had today. So let me quickly just refer to episode number 2 is the Tax Cut and Jobs Act overview with Brian and Rob Krigler. Episode 17, Brian revisits the TCJA with Aaron Alexander and Ryan Drake from our headquarters tax team. On episode 32, Scott and Brian talk about the Secure Act. And then Scott and I wrote 2 articles in the last couple of months on the CARES Act for businesses and kind of the overview. So that's available on MarinerWealthAdvisors.com. So take a look at those resources and be sure to let us know if you have any questions. As always, we encourage you to share the podcast with friends and family you think would benefit from hearing this information. And as always, we love to hear from you. So let us know how we're doing by giving us some feedback. And if you have any ideas for a future podcast, be sure to let us know by emailing us at podcast@MarinerWealthAdvisors.com. So we look forward to being with you on the next podcast.
Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. Additional fees may apply for tax planning and preparation services. Securities offered through MSEC LLC, member FINRA and SIPC.